What is up, everyone? Good morning. It is February 19th here, Wednesday. We've got a few days left of the week as we start with a short week. And yesterday I was talking about the perceived slow grind higher, but it seems that moving into all-time highs here on SPY and other ETFs like the triple Qs, we're starting to get a little resistance and a little pushback by the sellers. Nothing crazy, but these failures constantly over the last 2 days pre-market have some concerns weighing to them. And speaking of ETFs are becoming, well, not becoming, but they're fairly popular in terms of investment holdings for a lot of investors, retail investors specifically, right? Just in general, there's a lot of attractive movement into these. For example, the SPY that we have here on the screen makes up generally a very good percent of the average person's or investor's portfolio for a pretty good reason. The benchmark index did close at fresh record highs yesterday and has returned more than 20% over the last 2 years, right? Those are pretty phenomenal figures, realistically. While there have been many ways to gain exposure to the S&P 500, many have been focusing on the cheapest way to do so, which are ETFs, right? I'm a big proponent of having a huge chunk realistically sitting in an ETF that has gradual growth. It's been projected to grind higher over time, especially if you have a long time horizon, since underperformers get scooted out and good performers stay within these ETFs. So the first ever listed ETF, the SPDR, the Spider S&P 500 ETF Trust, which is the SPY, it did top its all-time highs, and it also slightly topped its arch rival, quote-unquote, in terms of AUM, assets under management. The Vanguard 500 ETF, VOO, which is my preferred ETF to actually hold, had nearly $632 billion in assets under management compared to the SPY with $630 billion, according to the calculations as of Tuesday, and not far behind iShares IVV, which has 609, wait, did I say 1,000? I mean, $632 billion and $630 billion, while the IVV has $609 billion. I don't know if I said 1,000, I can't remember. Of AUM based on its share count. So investors and financial advisors are getting more price cautious, especially in the era of do-it-yourself investing. The low-cost Vanguard ETF, the VOO, and BlackRock's IVV feature an expense ratio of just 0.03%, where if you compare that to the SPY I believe is around 0.09 or maybe 0.95, something like that, percent of an expense ratio, which is triple, realistically. The first two have also recorded inflows of $115 billion and $87 billion, respectively, in 2024, compared to just $17 billion of inflows into the SPY. So State Street does offer a SPDR portfolio, SPLG, with an expense ratio of just 0.02%, which is more catered to the buy and hold investor, right? So that's an option as well. And name, brand, and founder status have been also associated with the ETF, as well as better liquidity for spreads for trading options, hedging, right? But at times indeed changing. So the S&P crown now belongs to Vanguard, which has been cutting its fees across the board. And earlier this month, the investment company announced the largest ever expense ratio reduction, which will impact 87 open-ended mutual funds and exchange-traded funds that save Vanguard's investors more than $350 million in 2025 alone. So we've seen these things notch up continuously. It seems like this year, the start of the year, we had some volatility that traders thought it's over. It's going to be 2022 all over again. But right now, we're grinding into all-time highs. I do have some concerns as we pump into these all-time highs right now. As I talked about before, right, over the past few weeks, I'm looking at tech as being underweight right now. I think that there is good value in tech for the upside momentum, but yesterday kind of shook things up a little. Meta is gapping down right now after losing about 3.5% yesterday. Amazon took a beat down. Google slightly lower, right? But things like Nvidia gapped up and pulled back. Apple's holding out okay. Microsoft holding out mediocre, and so is Tesla. There's a decent little pullback on a lot of these names, whether it started yesterday or whether it's been going on for a few weeks now. And realistically, it does make sense that these markets are struggling at all-time highs based on what's going on with a lot of this big tech, which is a huge component overall of the holdings in the indexes, right? Specifically the SPOOs and the Qs. So what I'm looking at right now is I do think that there is some upside potential in tech, but it seems like it might have some bottoming out to do, which is a little interesting because these short weeks are usually tied with lower volatility, which surmounts to a general grind higher. But one of the interesting factors that we've noticed over the last 2 days pre-market is a slump of the S&P 500 futures as well as NASDAQ futures back into auctions lower. So there's a specific level at 61.43 on the S&P 500, which is a general balance top that's been trading over the past 2 weeks now, I guess, or a week and a half, you can say, that offered some immediate resistance. So this is a pivotal region that allows prices to move from a higher balance to a lower balance. So the higher balance meaning if we can actually get that move above this 43 continuously on a regular trading hour session, the potential of meeting that all-time high starts to increase. Now, on the other hand, if we keep failing it like we've been doing over the past 2 days here pre-market, I'm a little more concerned with the potential of the upside grind from there. So as I'm looking at this, very, very pivotal today, if we can actually rebid that 43 area, and then we're going to be targeting 60 and so on. But right now, as things stand, right, we have to be very cautious of the potential of the sellers under this area. So there's a little back and forth, and with tech seemingly a little weaker here across the board, it doesn't really seem like there's too much optimism even into these all-time highs. Maybe we have to wait until next week until big money comes in and says, you know what, fair enough, let's do this. So we had Trump yesterday. I didn't really catch up on what was going on, but today we do have the FOMC meeting minutes. It didn't seem like Trump's tentative speech yesterday shook the markets up. I know probably there was some tariff talk, but I'm not too up to date with that. I am mainly looking at the FOMC meeting minutes, which again is not a rate decision event. They're going to be discussing last month's meeting, breaking down some of those factors. And if you recall, last month we did not get a dot plot. So I think the dot plot might be coming in the next meeting with the expectations for rate changes. But generally, even with the Fed meeting minutes coming out, there's going to be a little more volatility, probably at 2 p.m. Eastern time. Something to consider for traders that are intraday looking at the S&P 500 and the NASDAQ. So to repeat myself, 61.43 on the SPOOs, the futures. I'm going to be looking for that as a major pivot for today. I would like to see the upside momentum continue, but if we open under this area, honestly, there could be some jolts to the downside where better buyers are looked for and found at lower prices. So I leave you all with that. We'll be on tomorrow. We'll do a stream tomorrow. I think like the whole world is sick. Everyone around me is sick. I'm not feeling too great myself, so I'm just going to take this day, rest a little, and we'll be back. Not trying to get too active today, but I do have a bit of concern here for this upside momentum. So we'll wrap it up. I'll see you guys tomorrow. Enjoy the trading day. Take it slow, take it easy, and we'll do it again tomorrow.